All right, we were going to get started. Most of you, maybe all of you, have already grabbed some food. Glad to see that. Please continue to help yourself. If you want seconds, I'll certainly respect you for it. And no issue if you're standing up and going back there during this event. My name is David Karlbach. I'm with the World Trade Center Utah. Very glad to see all of you here today. Hopefully we'll have a few more people join us as the session progresses. World Trade Center Utah, as you probably know, is a private nonprofit here, supported by our board, supported by the state legislature as well, and supported by our members, with the mission of connecting Utah and Utah companies with the rest of the world, and the rest of the world with Utah and Utah companies. And one of the ways we do that is through events like this, educational event, networking event, both where you can learn about a very valuable set of issues, in this case about transfer pricing and FX risk hedging under the term of Cash Compass. So I'm not going to say much more. Going to leave it to our speakers. We're very happy to have partners here speaking with us, including Jared Van Orden from GPS Capital, Levi Brewer from FORVIS, as well as Maria Gonzalez from JA Del Rio from Mexico City. And we're going to start with Levi. So I'll turn it over to him. Thank you all very much.
All right. Hi, everybody. Thanks for being here. It's great to be here. So just a brief intro. My name is Levi Brewer. I'm a manager at FORVIS. I focus on transfer pricing. If you don't know about FORVIS, FORVIS is the 8th largest accounting firm in the US. So we do a CPA advisory firm. And so that includes your traditional tax and audit services, but also consulting, which includes a variety of things. One of those is transfer pricing, which I am part of, which kind of falls under the international tax umbrella. So that's just a brief intro about me and FORVIS. So if you want to go to the next slide. Really, my segment of this presentation is going to focus on the transfer pricing aspect of cash management on a global basis and how to move cash between legal entities within the transfer pricing regulations. So these are kind of going to be some of the topics I'll be focusing on in this segment. So if you're part of a company that has international operations, you most likely are familiar with transfer pricing and most likely are doing that with foreign subsidiaries. But just as a brief overview of what transfer pricing is, in case you're not familiar with it, really what it is intercompany transactions between two related parties. So if you have two related parties that are in two different countries and they are interacting with each other, then there's going to be a need for transfer pricing. So that includes things like the sale of tangible goods, the provision of services and the payment for those services, the transfer of intangible property and any royalties associated with that, and then financing transactions. So think about like intercompany loans, guarantees, and the reason transfer pricing is important is that tax authorities care about it. And the reason they care about it is because depending on how you set your transfer price, so what you are paying and charging for intercompany transactions can affect the taxable income of a particular entity. And so tax authorities in various countries have the right to come in and adjust your transfer pricing if they think that the price you're charging is incorrect or not arm's length. And therefore, you're at risk of paying more in taxes if they do make any sort of adjustment.
Who's this?
Tax authorities. So the IRS in the US, yeah, you know them. and every other country's tax authority can do that as well. So really in transfer pricing, we follow what's called the arm's length principle. So when we're pricing these transactions, they have to be priced in a way that is as if the two parties were unrelated. So even though they're related parties, the transaction needs to be priced as if they were unrelated. So it needs to be a fair price. It can't be too high or too low, because then the tax authority can say that you're moving too much money in or out of the country. You can go to the next one. Okay, so there's a few different ways to move money between legal entities. One of those is through intercompany transactions, which I just went through. So you're paying those royalties, those service fees for services, those interest rates for intercompany loans. Those are kind of some of the common ways to move money through transfer pricing. There's a couple different other points to mention here as well. One of those is what we call a cash pooling arrangement. So most of our clients that have a cash pooling arrangement usually have a lot of different legal entities in different countries. And it's a way to make sure that each entity has enough cash to operate on a daily basis. So what they do is each entity takes excess cash, usually every day overnight, and that excess cash is swept to a centralized bank account and then distributed to entities that are short on cash. So what happens with that on a daily basis is make sure, okay, entities that are short on cash have enough cash to operate, but it also creates intercompany interest and intercompany expense. So you have entities who are net lenders, they have excess cash and they are lending and earning interest. And then you have entities that are net borrowers, or they are short on cash and they are paying interest. So that's another common way to move cash as well. I think we have Q&A. Yeah, we'll come up and sit here and do a Q&A session at the very end. So that's another way to move money, is through these cash pooling arrangements. And then a couple other points here is foreign exchange gains and losses. Depending on how you set up the intercompany transaction, you can transfer that FX risk to one entity or the other. And so they are either exposed to losses or participating in those FX gains. The last point here is dividends. You know, that's a common way to move money. If you have a company that has excess profits, you can pay a dividend, and that's a way to move cash as well. There are some downsides to that, which we'll talk about in the next slides. So why is transfer pricing a way to efficiently move cash? One of the ways is that transfer pricing is it's known. And so because it's known, you can know what the profitability of a particular entity is going to be at the end of the year before the year is even up. And so usually when you do a transfer pricing study, you are coming up with a range of arm's length prices. And so you have some flexibility and to target a particular operating profit or a particular markup on costs within that range. And so that makes it so that you know at the end of the year what the profitability of that entity is going to be, and you can know therefore how to treat any excess cash and move some cash within that arrangement. I mentioned dividends on the last slide. That's a common way to move cash, but from a tax perspective, it's not as efficient because you're going to be subject to withholding taxes. Most countries have some type of withholding tax that is going to be applied to any dividend payment. So if you're moving cash through transfer pricing, you can avoid those dividend payments. All right, so I've been talking a lot here, lots of words. Let's go through a simple example here to kind of illustrate what I've been talking about. So there's two different related parties here. We have a US related party on the right, and then we have a Chinese subsidiary on the left. And the Chinese subsidiary has a factory. They're manufacturing smartphones and selling those smartphones back to the US. The US then takes those smartphones and sells them to its third-party customers. So when the US is paying its Chinese subsidiary for those phones, that's the transfer price. And you have some flexibility with how to set that price, and therefore can affect how much profits are going to China and how much are retained in the US. And in this particular example, they're operating on a cost plus basis. And so China is being reimbursed for all of its costs of manufacturing, plus some sort of markup or some sort of profit element on top of that. So this is a very typical transfer pricing arrangement we might see. So I want to talk a little bit more about foreign exchange risk just from a very high level as it relates to transfer pricing. When we think about two different parties that are involved in a transfer pricing transaction, usually we're assigning one of them more risk than the other. So if you can go back to that last slide really quick, in this example, China is considered limited risk. All right, it's just performing manufacturing and it's being reimbursed for all of its costs with a markup no matter what. So it always has a profit and therefore it's low risk. The US related party, on the other hand, bears the risk because it could be, theoretically operating at a loss and still it's reimbursing China for its costs with a markup. And so that's one way through transfer pricing that we can separate the risk. So if you can go back to the next slide. So if we think about this with foreign currency, exchange variations, we can also think about, okay, who's bearing that FX risk? And depending on how the transfer pricing is set up, we might have one entity, in this case, the US, that's bearing the foreign exchange risk as well. And it's therefore exposed to any FX losses, and it is able to benefit from any FX gains. So I'm going to pivot a little bit now to talking about a cash management function on a global basis. So if you have a multinational company that operates in different countries, there's usually going to be some type of treasury function that's performed at a central location. And so since that's a valuable treasury function, usually there should be some sort of service fee associated with that as well. So that's another way to move cash from the service recipient entities to the service provider entity. Usually that's performed in the form of an allocation of those costs with a markup on those costs. So you're shifting some cash from the subsidiaries who benefit from that cash management function to the other related party entity that provides those services. These last couple points here, we kind of already discussed a little bit, but basically with transfer pricing, you have a lot of flexibility. There's that arm's length range. And so within the bounds of the law, within the transfer pricing rules and regulations, you do have some flexibility to move from kind of the lower end of the range to the upper end of the range and target a point within that range. And because of that, you can affect, okay, how much profit am I shifting from one country to another? And that allows you to move cash and also affects your taxable income. So that's kind of the key takeaway, is that you do have a lot of wiggle room within transfer pricing and flexibility to move cash where you want to. So I'll wrap up my portion right there and turn it over to Jared. And as we mentioned, we'll all sit up here at the end and take some Q&A for all the sessions.
Awesome. Thank you, Levi. So we do have a little crossover between all of us, which I appreciate giving these presentations because of that crossover. Everybody who does business with Levi and Maria also does business with us in a lot of cases here. So go ahead and just quickly go through the next couple. I'm Jared Van Orden. I'm with GPS Capital Markets Foreign Currency Exchange. We're an FX brokerage. It's just headquartered here out of Salt Lake. Very unique. There aren't a lot of FX brokerages in the United States in general, so it's very unique that we have a headquartered one here in Utah. But we mainly help companies. If you really think about what I do, I help companies protect cash and protect margin if they have international business. From this perspective, in talking a little bit about transfer pricing, what is the worst expense to pay in your company? It's taxes, right? And not only can you end up paying taxes once, you can actually end up paying taxes, triple taxation in the United States. If you were to sell a product from the US to your subsidiary in France, and then they turn around and sell it, France is going to be profitable. They're going to have to pay taxes in France. They're going to declare a dividend to get your cash back to the US. The US entity is going to pay taxes on those revenues or those dividends as well. They're going to distribute to shareholders, and shareholders are going to pay taxes again. So it can be very costly. So getting your transfer pricing done correctly is really important in minimizing that extra tax bill that you don't actually need to pay. I'm going to run through three really common structures. Let's go back one more for a second. I'm going to run through three fairly common structures of how companies do their business. This one typically applies to more of SaaS model company, but there are others that do it. In this case here, we have a company that's headquartered in the United States. They do have offices in France. They do have sales employees in France or anywhere in the EU, and they are selling to customers. Those customers can pay either in US dollars or they could be paying in euros or pounds. But in this case, they're writing all those sales contracts where all the revenues are being allocated to the US parent. So all the cash flow funds are going to the US entity. The US entity then sends money to France in this case to cover costs, payroll, rent, minimum taxation that France requires them to send in order to be profitable in that country. So this is more of a cost plus type structure. So the only risk on the parent company here is where they're receiving US dollars on all revenues is that they have to pay that payroll and those costs over in France. And so they have a one directional exposure to buying euros every single month to make those payments. Go ahead and go to the next one. In this case, I've taken it one step further. This company is a US based company. They're having their bags manufactured at a maquiladora down in Mexico. They're having to purchase pesos in order to pay for those expenses. They're receiving the product here in the US. Cotopaxi bags is probably a good example here of one of those, right? And then they turn around and they sell their product in US dollars. So to this company here, it may be all their international distributors might also be buying from them in US dollars. And so truly to this company, their only exposure is to the Mexican peso, even though they have manufacturing costs. And one more. And this is taking that previous example and just adding one more complicated element to it. So in this case, we still have the same exposure to the peso on the cost side, but now we're selling the product to a subsidiary that's in France. We're having to sell that product to that subsidiary, and then that subsidiary is then selling it to the customer in euros. So from a transfer pricing perspective here, they have to sell the product and choose what price to charge to that French entity. I have sat with CFOs that have told me that in this case here, the sales to France, it doesn't really matter because, you know, if the rates move one way or the other, it hurts one entity and helps the other. That's a lie. That is not how it works at all. The US entity, if they are selling their product in euros to the French entity, the French entity has a payable in euros. There is no change to them. They just are going to pay for that product in euros. They're not going up and down with the exchange rates at all. But if the US entity is selling the product to France and they are billing them in euros, their revenue stream is going up and down in value with the euro. So it's not true that one benefits while the other one does not. They don't offset. One is hurt and one is not. One stays constant. Okay, and to give you an overview of the markets, it's funny, we gave this kind of presentation back in 2020, and the rates are completely different and completely different direction than we were talking about in the middle of COVID. So to kind of give you an update, if we look back here from 2020 up until now, you can see that the Japanese yen has had a huge change. Japanese yen was trading around 100 to the 110 range, and now we're all the way up to the 147 range. You look at that change, that's a 43% weakening of the Japanese yen. I know of a company here in Utah that repatriates $5 million cash every month from Japan. So $60 million cash each year, 43% of it is now gone. That's a little bit painful. Let's go to the next one. I'm going to go over 4 different currencies here, probably the more common ones that we deal with here in Utah. The euro. If we have revenues that are coming from Europe, you can see here that going back as far as 2021, that we had a significant weakening of the euro. The war in Ukraine being a big factor in that. The US raising interest rates also strengthens the US dollar, which means the euro weakens against the US dollar when that happens. So you can see here a downward movement is the euro weakening against the US dollar, and it gave up almost 23% of value going into 2022. And we've recovered a little bit of that, but not all of it. This is the Canadian dollar. I only went back to 2021 on this. You can see it's a lot more stable, but at the same time, it's still weakened 13%. So revenues in Canadian dollar have dropped 13%. And the Mexican peso. So when Trump was elected back in 2016, the Mexican peso weakened like 8% or 10% in the middle of the night. That put Devin and I on the phone with all of our clients buying pesos saying, hey, we know you have your forecasts. You should lock this in. And so that worked out really great. We saw the peso skyrocket well above the 20 range, 22, and on forward contracts, even all the way up into the 24 range. So things were great if you had manufacturing in Mexico. Fast forward to this year, or the last couple of years, the US has been raising interest rates. Mexico did too, and they outpaced us. And not only that, as we saw the euro starting to strengthen back a little bit against the US dollar, here we can see that the Mexican peso outpaced the US dollar significantly, almost up 23% since 2022. And so if your manufacturing is being done in Mexico, now it's more expensive to get that product, right? So if you are even just sending dollars down to Mexico, you have great suppliers down there. Maybe they're pricing you in US dollars, but they're feeling a pinch right now. Your dollars coming to them and being exchanged into pesos are worth 22% less when they exchange it into Mexican pesos. So they're going to have to raise costs on you at some point in time, or they simply take a 23% reduction in their margin. If they only have a 33% margin, now they're down to 10%, which is very painful. So you can see these small fluctuations in exchange rates can significantly impact the business. I am friends with Jacob Durham. I do not have his permission to put this all in here, so I'll beg for forgiveness after the fact. But Nomadic Bags, Jacob's an old classmate of mine from the accounting program. I have a master's degree in tax accounting. I just didn't go into tax accounting. But Nomadic Bags just so happens to sell a bag for almost exactly $100, which is what I wanted for this example. And so that's why I put it in here. You can see that if Nomadic wants a product price of $100 and they decide that they're going to go sell this bag in Japan, the European Economic Zone, Canada, and Mexico, that with that exchange rate up there, kind of to the far right, that's going to be their pricing in the local currency. Now they're going to make adjustments for taxes and shipping and some other minor adjustments. But if we were to ignore all that, this is what they would charge for their product. Go ahead and click it one more. Now, I basically fast forwarded everything that you saw on the previous few screens to say, okay, that's where we were we at today? If these revenues, they've set their pricing up there, right? The product price on the far right, the exchange rate changes. We can't go back to our customers and say, hey, we need to charge you 20% more. Usually, if you could have charged an extra 20%, you would have done that in the first place. But in this case here, you can see that with those changes in exchange rates, the margin, I assume they had a $50 cost and that their margin was about 50%. You can see that those changes in exchange rates at that same price have dramatically reduced their margin in those three upper currencies. The Mexican peso, because it's strengthened, works out great, but most companies in Utah have costs in Mexico and not necessarily revenues. And so probably that's hurt more companies in Utah than it's benefited. You'll notice that if I change the cost structure here, if I say that their costs are $70, so their margin's 30%, the less margin you have, the more sensitive your company is to rate changes. So if you only have a 30% margin and those same changes happen, you can see that they're in Japanese yen, they're only left with 10% after that rate fluctuation. It just comes right off the top, is really what it comes down to. If you have a 20% margin and the currency moves against you 10%, that 10% is gone. You lost 50% of your margin because of a 10% change in the exchange rates. All right. Interestingly enough, it is extremely simple to solve this problem. There are some complications to it. One is we'll go out and we'll talk to the client that, hey, you need to forecast all of your spend into Mexico. If it's payroll at a factory down in Mexico that they own, is pretty predictable. They can, to a certain extent, predict 80% of what their costs are going to be down in Mexico. So we come out and we say, okay, there's some sign mistakes here, but you see if we're sending 4.5 million pesos down every 2 weeks to Mexico, that's going to cost us, somewhere around on the far right there, using that spot rate up above, about $258,000 every time we make that payment to Mexico. So we're going to be sending about $6.7 million. Well, if we go out and we say, okay, what if we lock the exchange rate on every one of these cash flows? What if we go out and we enter a contract to buy 4.5 million pesos with a delivery date of every delivery date you see here on the far left? You'll notice that exchange rate here in this third column, you'll notice that the further into the future we go, the better the exchange rate gets. I'm going to grossly simplify this, but basically because interest rates are higher in Mexico than they are here in the United States, you can get a higher return on your money if you were to move it down into Mexico. And so when you lock the exchange rate today for a future delivery, we're actually making a decision to do the deal today with the future delivery. So everything's just a time value of money adjustment from today. Well, because I get a better return in Mexico, if I lock the exchange rate today for a future delivery date, I'm awarded that benefit in the form of a better exchange rate when I lock it in today. So you'll see that the further I go out to the future, I'm picking up a pretty significant gain. In this case here, I'm showing about a $316,000 benefit if you lock this in. So insurance policies are great. What about an insurance policy that actually pays you to put it on? Even better. The Mexican peso I did show you had strengthened significantly. So why would you maybe not put this on right now? Or what are the scenarios you're running into? Well, we did just see the Mexican peso strengthen 22%. So you're at a point now where you lock that in. It would have been nice if we locked that in 12 months ago, because we would have had this forward point carry in your favor from the rate 22% ago in your favor. So maybe we're sitting 25, 26% better than market back then. And we've locked in for 12 months and we're avoiding all of this today. Much, much better. Well, now we have to make the decision at this strengthened peso rate. Do we want to lock this in? Yes, we're going to pick up some gains here on the forward rate and different hedging strategies we can do, but our starting point is at this strengthened Mexican peso rate. I did the same analysis on euros. Euros is also in our favor from a revenue perspective. I should have mentioned that. If the rate moves the same direction out into the future, so if you were buying Mexican pesos, the rate gets better into the future that you lock it. What if you're actually a seller of pesos buying dollars? Think of like ready-mix plants that's down in Mexico that produce powder and sell it, and then are repatriating dollars back to the US. The rate moves the same direction. So you actually get a worse rate the further into the future you lock that from a Mexican entity's perspective. Here in euros, if you're selling euros, the benefit is in your favor to lock it in the further into the future you go. If you're buying euros, the further into the future you go, it's actually a little bit more costly. So you are paying for that insurance policy to lock it in if you're a buyer of euros. I want to mention how extremely simple this is. These are 2 screenshots from our online platform. You can literally go in, hit get rate, choose a value date of when you want to buy these funds to, and it will come up and show you what that rate is going to be. We have, in the accounting world, using the term derivatives is a bad term to use, but it is so simple to do. And a more simple way of thinking about this is a rate lock. We're simply locking the rate on a specific amount of funds to a specific delivery date. Now, it is a contract. We are obligating ourselves to do this. We have no more upside potential if the rate were to run into our favor, but we're also giving up all of our downside risk. So to give up all your downside risk, to give up all your upside potential to not have any downside risk is still a pretty great deal to go with. And so again, as far as international structures and trying to protect cash flows, this is really where GPS comes in. We do a few different things, but as you're trying to structure how your company moves money around the globe, this is where we like to be the phone a friend option. If you're sending dollars to China, maybe there's no foreign exchange involved in that, right? But the Chinese renminbi just weakened quite a bit. In the past year, A lot of our clients had their suppliers from China coming to them and saying, hey, we're really hurt by the exchange rates right now. You're paying us in dollars, but when we exchange it to renminbi, we're getting less renminbi for your dollars. And because everybody wants to be a good business partner, a lot of the US companies have accepted those price increases. Well, now it's flipped the other direction. And I would bet that not a single of you that do business in China have had those Chinese suppliers call you back and say, hey, guess what? It moved back in your favor. Let's lower your prices 5 to 6%. It doesn't happen that way. So even if you're only doing business in US dollars, there are still strategies and tactics that can be employed to simply talk to the suppliers and say, hey, the rates really moved in your favor. Can you pass any of that back to us? Simply asking, we had one client get a 5% cut in their costs from their supplier just by asking the question. So as far as Devin and I go, we'd love to be all of your phone a friend option, even if we're not doing business together. If we can tip you off on tactics to use for your business, we'd love to help you out and explain the in and outs of dealing with foreign currency. I've explained some very simple examples here, and I'll take questions going forward. But I think that's pretty much good for me.
Hi, everyone. Really nice to meet you all. Thank you for inviting me here. Well, the idea, I think, basically, well, I'm Maria Jose Gonzalez. I'm Transfer Pricing Director. I work in JA Del Rio, and we are allies of FORVIS. Probably that's why I'm here. But the main idea of this is just to catch all the things that Levi and Jared have shared with us and put it in an example, obviously in Mexico. That's the one that I'm going to talk on how this looks, what is affecting Mexico, and at the end, how can this affect your company? So I'm going to go a summary on what already has been said. In Mexico, for your knowledge, in 2022, we closed with a 19.5 peso per dollar. At that time, we thought that we were great. In 1 year, we gained 4.9% equivalent, almost 1 peso per dollar, because, and we were in levels before pandemic. I'm going to show them, but if you look the graphs, in beginning 2022, we were in 22 pesos, so we already won. But what has happened in 2023 is we have an accumulate appreciation of 18.8%. It depends on when is your starting point, to 22 or 18 points. So Jared already explained all the benefits of all the issues that this has, but we are talking about 8 months, and to put it in pesos, we are talking about 2.5 more pesos for each dollar you have. So at the end, in 2 years, you have 3 pesos per dollar. Good for Mexico, not so good, and depending on the player in Mexico, not so good so this graph, what it shows is exactly what I'm saying. For example, in January 22, at the end of 21, we were in 22, now in 17. This is explained for a lot of factors, but basically it's the picture right now. Next one, please. Just for you to know, we are the second currency with the highest performance against the US dollar this year. The first one is a peso colombiano. We have offices in pesos in Colombia, so it's also an issue, and peso mexicano is the second. And what is happening, and I'm putting the Mexico example, but it can happen in any country, and more related to economies that are not that strong as the US economy. As general terms, we have limited account deficit of 3.6 of GDP. What this means is that our income as a country, we have deficit, but it is controlled. So this gives perspective of a steady economy, or that you're not going to go wrong for that. And this account obviously has income involved, and one of the main incomes in Mexico come from exports, and the other one from remittances. That is the money that people from working in the US send to Mexico. It's around 5% of GDP. Other thing is restrictive monetary policy. We have right now a targeted interest rate of 11.25, as already Jared mentioned. It has been increasing. And this represents capital movements. I mean, people, since the country seems to be steady in other areas, people are investing or sending their capitals in Mexico, and this affects directly to the exchange rate. And our country risk is going down. In 2022, we were on 4, and now in 3.8. To see it in graphics, this is the current account. As you can see, the importance of this is the last decade, almost the deficit is pretty similar each year. So we don't have big peaks or lows that may create a bad expectation on the country. The next one. And this is the differential in interest rates. And the important thing here is that you see that Mexico behaves like the US in response, always. I'm going to talk about that later, but Mexico is really connected to US economy. So if you are affected, we are affected. If you are going well, we are going well. And this is an example. Federal fund, the interest rate of the Fed was increasing over time because inflationary pressures in US, etc. And Mexico has the same reaction. So what is the expectation is to capture all the capitals and movements that can be done, obviously controlling the inflation, because otherwise we are affected with inflation. But this spread explains a lot of what is happening in the exchange rate in Mexico. In the external factors, as I mentioned, we are really attached to US economy. So as long as you're resilient, as long as you are good and you're supporting there, Mexico has the opportunity of growing expansion exports and remittances. Even though the exchange rates affect a lot in exports for Mexico, and it's one of our main incomes, right now it's been a little bit compensated because we are expansion exports. So it's been it's a dual thing. Another thing is the expectation that the upward cycle of the reference rate, the Fed funds, the Federal Reserve is about to end. So no one is expecting to increase more the rate. In Mexico, for sure, the authorities already said they are not gonna increase more the rate. So it's something that has helped. I'm going to talk about this, the high expectation that nearshoring will attract a strong foreign investment to Mexico. And this is related to location. Mexico is next to the US, and things are happening around with the supply chains that obviously has benefited in some industries to Mexico. And at the end, well, in the markets at least, they have positive sentiment about the currency. Next, please. And so the nearshoring basically relocating companies or functions to location, to what is near, depending on what is happening. So you know more better than me around what happened in the world and the US. But what I'm trying to explain is that in the past years, companies, probably you have suffered a lot of disruptions on your supply chains. Many factors, US-China trade war, pandemic, Ukraine war, obviously as a consequence, an increase on oil prices, increase on raw materials prices. And this at the end leaves with delivery times shortage. We have problems with delivery times for your products. The logistics cost, I didn't bring these graphs, but the logistic costs in pandemic for the US were in some countries 5 times of what it was before. And obviously consider other benefits or costs in each of the countries. So these fast years has been moving and moving things around related to business. So for example, this is data of 2022, but for manufacturing entities, depending on what you're looking for in your strategy is your movement. So for example, all clothing, apparel, etc., practically is staying in Asia, in Vietnam, Bangladesh, but low mid-cost, but closer to demand that it is not the lower cost. Electronics ICT basically is going to Mexico. And obviously some things are moving back to the US and some things will stay in China because the big investments are on the supply chains. Commercial US partners, as you can see, Mexico gets a place the first place in 2021. China is historically has been the first one. And now we are Canada in second, and China is going third in this scenario. So when I say commercial US partners, practically I'm talking about foreign trade. And this is how the picture looks, and 2023 has the same tendency. Next, please. So what this means is this is the losing and countries. Right now, from 16 to 23, 7 years, almost 10%, 9% has been shifted from importations. These are the countries that are losing the imports in the participation in imports in the US. So basically, obviously China is one of the major, and we have other countries, but the good one here is who's benefiting from this. The next one, please. So Mexico is the one that is, I don't know how, it's 18%, but Mexico is the one that is winning with this shifting things of imports. Basically, we have maquila processes. We have a lot of things that may help to this scenario. Vietnam is the other country helping, and other countries which means that the US is diversifying its countries or preference. The next. And well, oil prices go up. Mexico has income in oil, is one of the main or the most important. So we are in a good position. For many industries, what it means is higher cost in the raw materials. So it depends on the winners. Next. So this is, and all this backup, just to talk about the exchange rate, because right now is what it is. But what we are looking or expecting in the future related to risk, well, there are internal risks. As I mentioned, we have a steady account deficit, but at the end, if the world economy is slow down, we will slow down and we will be affected. Interest rate spread, if the Fed decides increase the rates, or Banxico in Mexico decides to decrease the rate, we will have less spread, and therefore the capital's movements, and this will increase our exchange rate. Our country risk is dependent on if US ever go to recession, our country risk will immediately increase. In the external factors, US economy, if US lost dynamism, we lost dynamism, there is no more. Inflation pressures that may take to other effects in interest rates, or supply shocks that affects the prices, and the nearshoring delays. For example, that the investment plans are delayed or not happening for Mexico, and the US decides to move to other countries. So all this to say, this is a quick example. I'm not going to read it. For example, if you in the US are a distributor of beverages, and you decide that you are going to distribute tequila. You're going to purchase your tequila with one price in one moment in time. Last year, already Jared gave the examples of this. So what is going to happen, or what are the decisions to be made? One, the supplier of the tequila is going to increase your price to be profitable. Two, they do not increase the price. US live happy with that, but it starts losing. And in a long term, it is not sustainable. Probably decisions in the short term can be done, or you can increase the price or not, but in the short term, it's not sustainable. Next, please. And if you add transfer pricing, what is really happening? If you have, Levi, Jared already said, no limited risk entity in Mexico. And for that limited risk is exporter. And now he's receiving less money, so they have losses. But it is not like, okay, they have losses and that's it. If our transfer pricing in Mexico is going to demand a profit, so you are going to have to move cash just because an exchange rate effect. You're going to have to increase the income in Mexico, pay taxes, and there is the losses that you will have. So basically the idea is, and for me, just to finish, just to say, what strategies are the companies are taking? Do you even thinking about it? And it's Mexico example, but I believe that it is each country example now, because Mexico is really the exchange rate was really moving, so it's a good example. But as already Jared offered, hedging the risk of exposure right now, it is important because we do not know what to expect in economies like us. And especially we have moments in government next year. We are dependent on US entity. So a lot of things can happen. It is not expected that the exchange rate to be lower, but we didn't expect to go to 17. So we don't know anything now. So basically that's what I'm here to propose, to say, and thank you, everyone.
Yes.
Yeah, wait till you have the mic though.
No yelling like that.
Yes, my name is Dean Martinez. So I wanted to know, for how long can you protect a rate? So let me give you an example. So we lend to a company in American dollars, a company in Nigeria. They sell in Naira, and it's about a 2-week period between when they're collecting in Naira and they pay us back. Can you help protect the value of that Naira? So that because as you guys know, the Naira is dropping against the US dollar. And so we need that kind of protection.
And pretty consistently, right? The Naira has been dropping for a decade now, right?
It has been.
And there is not a hedge market for the Naira. If you do look, supposedly there's an onshore market for hedging the Naira, but it does not exist outside of the country of Nigeria. So that makes it a little bit problematic because I cannot go and lock the exchange rate for the Nigerian Naira. Plus, it also has to be exchanged in country to pull the funds out. So you have to do business with the Nigerian bank in order to get the money back out. And they're not hedging, right? And that's the problem. I can't hedge it for you outside of the country. If you look, there is reporting of hedging being done, but my understanding is it's only being done in Nigeria. So it's not something a U.S. institution can help you out with. No U.S. financial institution can help you out with locking that in. Ideas. My thought is maybe if we look at a synthetic hedge that looks at multiple different basket of currencies and find some that are mimicking the movements of the Naira, you may be able to hedge it in a form. You really want your effectiveness to be above 50% before you'd go out and do something like that, and then also consider the cost of doing so. The Nigerian Naira, I've seen it where it's weakened 50% in 1 year before, which is problematic. What price do you choose to sell your product for if it's weakening at that level, right? It's very hard to maintain margins when you're seeing that and you're constantly changing prices. So I wish I had a little bit better answer for you. I can see through Bloomberg and Reuters and other reporting tools that somebody's reporting forward rates on the Naira, but it's not with any of the U.S. institutions. And so the only thing I can think of is it must be with a Nigerian-based bank. Yes, I'll give it to you when we're done. That was a hard one, though. Thank you.
Mr. FORVIS, can you tell us if you're going to give us CPE credit? And then are you in the local office? And would you step us through a transfer pricing study, what that would look like for a $20 million Utah company with a Canadian subsidiary? Talk to us what you would need to put together that transfer pricing study. And then how often do you update that?
Yeah, definitely. So CP, I don't know, Rayanne, if you know if this is provided for this event. I'm guessing no. And yeah, I'm located here in the Salt Lake office. So I just a couple blocks away is where I'm at. And as far as how a transfer pricing documentation study would work is we usually have different options of scope depending on one, the size of the transactions, the complexity of the business, and how much volume the transactions are. So we can prepare what we call a full scope documentation study, which would meet all of the US documentation requirements and all of those in Canada, or we can prepare a more limited scope study that would meet most of the US documentation requirements and most of those in Canada as well. And it really depends on the size of business and kind of how much you want to spend on such a study. And we've had clients that have done more of a limited scope study, and it's been looked at by the IRS and been accepted as well. And so that would be prepared on an annual basis. The tax authority expects that transfer pricing documentation is done annually, and it must be completed contemporaneously, which means it needs to be completed before your annual corporate income tax return is filed. And so that would be updated on an annual basis. And the basic process is we would do some fact finding to learn more about the transactions, go back, do our analysis, perform some benchmarking, look for comparable companies, and come up with a range to provide to you, and compare that against what the actual margin was on that intercompany transaction between the US and Canada, and then write that up into a report that could then be provided to a tax authority if they asked for it. Range of fees, is it one transaction or two, or? I would say more of a limited scope study can be maybe 10 to 15, and a full scope study can be 20 to 25. That's going to depend on how many transactions you have to analyze, how many legal entities there are, and then what kind of fact finding you're doing. So that's rough ballpark, but somewhere around there.
We've got time for one more question.
Your pop-up window for exchange, future exchange, is that available to just clients or to anybody?
Just clients. There is a decent amount of due diligence has to go into that to get clients onboarded. And then there is a small credit factor in allowing entities to lock into contracts, right? When we enter into these contracts, we are in fact obligating ourselves to deliver on a certain amount of currency. So if you decide 6 months down the road to not deliver on it, that does cause a few complications. So once a client's been fully onboarded, then we just make that available to them.
Thank you very much. Jared, Levi, and Maria, thank you very much. That was very informative. Great that the markets helped you by creating lots of volatility and being able to demonstrate the value of your services. And hopefully those in the room found it valuable as well to learn about the issues and learn about some of the solutions and ways to mitigate those risks. Feel free to stay here in the room if you want to network at all with our panelists. I assume you guys can stay for a few minutes, so feel free to come up and ask questions, exchange cards, get more food. We have this room for a while. And this was also recorded, and we're going to be distributing a link to this recording sometime tomorrow. So again, thank you very much. And the